The governor of the Nigerian Central Bank, Lamida Sanusi, raised the cash reserve ratio to about 4% from 2% last week. At the same time, the MPR rate was also raised to 8%. What effect have both those rates that have been increased had on the primary and bond markets?
Well, in terms of the impact of those rates, they went up end of May. The impact on the secondary bond markets for FGN bonds has seen a significant increase in the yields. The yields have probably gone up almost close to the increase in the MPR. So you're seeing yields on the 5-year hovering about 12.6. Before the announcement, they were probably closer to 12. So they've clearly had an impact on the secondary market. On the primary market, the impact is yet to be felt because we really haven't had any significant new issue come to the market yet. But I'll guess that any issue coming to the market has to adjust for the fact that the FGN rate has gone up, and so therefore everybody else's rates could potentially go up for those issues that haven't yet firmed up their buyers.
On the other hand, the Debt Management Office of Nigeria plans to sell about 70 billion naira in a 3-year to 5-year sovereign bonds next week. What is the viability of launching these bonds?
Well, I mean, the DMO has a systematic pattern of issuing bonds. I think yet to date, compared to last year, they're just about 6% above what had been issued by this time last year. So it's a very systematic programmed approach. In terms of the yields that will come out of that auction, given what has happened with MPR, it's possible that you'll be seeing the 5-year close to 13%. But again, it'll also be a function of how much liquidity is left in the system after taking out probably 300 to 400 billion naira from the system due to the adjustment to the cash reserve ratio.
So do you think that the market can actually absorb these sovereign bonds that are coming through?
The market will definitely absorb the bonds, and what you normally see is that if the rates are significantly higher than the high 12%, you have oversubscription. So the market will definitely absorb the bonds. The question is really at what price, and it's probably going to be slightly higher than where the secondary market is trading now, which will be close to 13%.
On the corporate front, there hasn't been much activity given the corporate bond side. What is happening on that end?
Well, I think the corporate bond side is a bit interesting. I think what seems to be happening is that the super blue chip corporates, who are the ones to be coming to the market now, given the infancy in this market, are simply getting cheaper money directly from banks. A year or two ago, it would have been cheaper for a high-quality corporate to issue a bond because due to the amortization and the rate they'll be getting, they'll work out cheaper even after paying issuing costs. Right now, it seems as if those corporates are managing to extract money from the banks at very attractive rates, particularly when you bear in mind they probably are getting the money without the higher issuing costs of a bond. All that will probably change towards the end of the year. The central bank clearly has an intention of tightening and moving rates up to suppress inflation and support the currency. And it'll probably get to a stage where those corporates can no longer borrow at those very attractive rates. So we'll probably see later in the year, but right now, only 1 or 2 in the pipeline.
Okay. Looking at the distressed bank, the date has been set at September 30th when the bank will finally, the central bank will finally pull the plug. Is there any chance of them going to the debt market to raise capital?
Theoretically, it should be possible. I don't know how practical that is in this scenario. Bear in mind that these are banks that are technically insolvent, and so their ratings clearly cannot be investment grade, either for the institutions or for any paper they're issuing. Now, if they find a creative way to get investment grade paper issued, the pricing will be probably prohibitive. But again, there are probably 1 or 2 of those banks that have decent enough balance sheets or decent enough prospects to pull off a tier 2 subordinated issue, but it will be very highly priced. The question is whether they are profitable enough to actually pay off that debt over time. But the time to that September 30 is quite short. So if they are planning on doing anything, those plans had better be in the works right now, because it takes a while to do a big issue in Nigeria, a bond issue.